And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Michael, good to speak with you. How are you?
Thank you, Zev. Doing well. Hope everything's good with you.
Thank God, thank God. So we're off to an interesting start this year. It's a new year. It's a new beginning. But I think it's been a little rocky so far, right? Rocky for a number of weeks. Market's been a little volatile. Things are changing. So from your vantage points, what's the prognosis?
So Zev, first off, again, the views expressed on this call are my views, not necessarily those of the bank or the broker-dealer. Having said that, I think what we're seeing is kind of a lot of what we talked about towards the end of last year. The market has largely been relying on three different pillars or drivers. First and foremost has been the Fed. Secondly was fiscal policy. And over the most part of the last 2 years, those have been quite stable. And really the swing factor has been COVID. And we saw the response to the market in early December, late November with the Omicron spike. We saw the market start to rebound a bit more when Omicron was deemed to be not as dangerous as the prior version. But now what we're seeing is there's a big change in policy from the Fed, and the long-term stability that we've had for the last 18 to 24 months from the Fed is changing. Again, if you recall, the prognostication from early last year by most folks in the market was that interest rates would remain stable all through 2022, and we would not get a rate hike until sometime in early 2023. Those expectations have changed rather abruptly. Again, economic activity has picked up. There's significant liquidity in the market. Consumer spending remains strong and healthy, and we're seeing a lot of elements of strong demand, as exacerbated with some of the supply chain issues. So ultimately, a lot of concern about inflation, which we've talked about numerous times over the last few months, have reared their head, and the Fed looks to be accelerating their policies. The issue that this brings, in my opinion, is that we're likely to see a year filled with a lot more volatility than we have in the past. And if you think about it in these terms, last year at this point in time, there was almost uniform opinion that monetary policy would be rather stable for the year. And again, kind of outlining what I just spoke about before. When you get into this year, there's expectations from some that the Fed will hike interest rates twice this year. There's expectations by others on the other end that they'll hike interest rates by as much as 5 times. And right now, the Fed funds rate, so kind of the market pricing mechanism, is anticipating somewhere around 3.5 to 4 hikes. So the point is that there's a wide dispersion of view and opinion as to what the Fed does. And when you have a wide dispersion of opinion, it means that there's going to be a lot more people that will kind of be offside or have to alter or change their views and opinions as the year goes on. Additionally, the Fed is also sitting on a historically large balance sheet, and they've indicated that they will find ways to shrink that balance sheet with the unwinding of securities. And again, we're still in the process of tapering, which will also do that. So when you look at those levers that the Fed's pulling, there's a lot more uncertainty about how hard they'll pull those levers, which levers they'll pull, when that will be, and what the path rate is. So again, that's why you're starting to see a lot more volatility in fixed income markets, and you're also starting to see a lot more volatility in equity markets.
See, overly optimistic, pessimistic about how things are going?
I think the key element, and again, Zev, we've talked about this a bit, and my views on this have not changed. I think it's most important for everybody to recognize what bucket the money is in. So again, if you have money that's allocated for long-term usage, so long-term retirement money or long-term education funds or anything that's deemed out there to be a 5, 10, 15-year time horizon, volatility is kind of your friend. It gives you an opportunity to buy cheaper, and ultimately, I'm a long-term believer in U.S. capitalism, and I believe in the long term the equity markets will continue to produce the results that they've produced. The question is, as you look into some of the shorter term buckets, the real challenge is going to be, what do you do for safety when the safe assets may be under pressure? So if you have buckets of liquidity or buckets of investments that are deemed to be shorter term, Can you sit in fixed income going into a rising rate environment? If you're going to be in the equity markets for short-term money, do you have the ability to stomach the potential for more volatility? So again, if the market drops if you put your money in the market at the beginning of the year and you're down 4 or 5% in the first couple of weeks, does that scare you? Does that rattle you? Or do you need the money to pull out? So I think the question really is, what is the use of the money? What is the time frame of the money? And then just align it up. So for, again, many of our clients that look at investments and wealth management as long-term prospects, the volatility is just noise that can be taken advantage of in the short term. But for people that are looking at short-term opportunities in a rising rate environment where fixed income markets may be negative, it may be prudent to even potentially move back into cash. So when we've talked previously, the return in the short end of the fixed income markets is rather thin. But as we're speaking right now, the 2-year Treasury is now providing, a 1% return. Certainly not meaningful, certainly not keeping up with inflation, but it's not the 25 or 30 basis points it was through most of last year. So I think that that's really the challenge of making sure that you know what your need or use is for the money, and then just allocating it appropriately so that you can withstand any volatility and just know what your risk-reward trade-off is.
Sounds like very good advice because things can go up and down, but things are moving overall. So if you panic at the first time it goes down, then it's not a good thing because you have to look at the bigger picture is what you're saying.
Yep, and we've seen plenty of stats, and it's not that difficult through a Google search to look up some of the data. The likelihood of a 5% or a 10% pullback in any given year is pretty high. And there's plenty of years that the market is up significantly or even in double digits with some of these intra-year pullbacks. There's plenty of research and plenty of data on it. And again, that's why the market favors the long-term investor. But again, for those that are not necessarily in it for the long term, I think that people need to be really careful. The other comment that I'll make, which I think is important, particularly as we head into the new year and start getting deeper into Q1, it's always a very good time to sit and try to assess the world going forward and also reflect on what did I do last year, what did I do in 2020. Did the things that worked in 2020 or 21, will they continue to work as we move forward? And again, a simple example is a lot of the stay-at-home type of stocks did very well when everybody was staying at home. As we continue to move forward, they may not work out so well. Some securities that really benefited from near zero interest rates may not necessarily perform to the same degree as interest rates rise. So again, always a very good time, like at these inflection points or these changes in paradigm, to really assess what you have in the portfolio, and regardless of what it did last year or the year before, what is its potential to do going forward. And that's something that we remain very diligent about with our clients.
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member investment committee for Leumi Investment Services. Thank you for being with us and giving us some insight to what's going on.
Thank you very much, Zev, and look forward to speaking again shortly.
And we're going to be right back.